Hello everyone, this is Novice Unicorn here. I'm not a professional trader, I am a prosumer, and I've been working on a strategy here for the last year, and I've had a few people ask me about it, and so that's why I'm making the video. I have pretty much, well no, I have a 100% win rate with this trade, and I have the numbers to prove it. Um, and it's kind of developed since the beginning of the year, and I do not know what happens to this trade in a bear market, but in a bull market or a pseudo bull market, this seems to be working fairly well. So it is my number one trade, and it is my number one most profitable. Well, my number one trade that I put the most capital into. Most of my portfolio is in this trade, and I run like 90% of my portfolio in this trade, and when the trade isn't working, or it's not applicable, then I just intraday trade. The theory on this is I've looked at a lot of charts, and I've looked at a lot of um, looking over charts, and I mainly use this trade in ETF, broad market ETF. So like right now, I use an SPXL, which is bull market or bull S&P 500. TNA, which is the small cap Russell 2000 ish bull, and then I've been starting to use it in FNGU, which is the FANG top 10 tech stocks out of the SPX. So those are my three, vehicles that I'm using in right now. And the theory is that on a down day, if you notice this chart, this is SPXL, which is three times leverage S&P 500. There's not a whole lot of wicking, and like so, this is a wick. And you have some wicks at the bottom here. You have a really large wick there. But if you look at the chart overall, there's not a whole lot of wicking, which means that when the price moves in a certain direction, it generally tends to move in that direction throughout the day, from open to close. And that's important to note. So, just to show this point, if you switch over to something like Monero, you switch over to Monero and you look at the amount of wicking that happens on a daily candlestick chart. You have opens that push, drop down, you have opens that drop down and they come back. There's a lot of intraday price volatility. And so when Monero, not saying to trade this, I'm just using this as a really good example, especially if you go back like when it was creeping up. Um, a, a chart that wicks this much, the open price and movement is not indicative of what's going to happen throughout the day. And that's the important point to look at. If you look at, where's SPXL? Sorry. If you look at SPXL, there's not a whole lot of wicking, which means that, there is some, but generally something has to happen pretty, impactful throughout the day to switch the movement of the current price or current feeling of the market. And so this general theory that I've been working on, especially in these broad market ETFs, like TNA, you can see I've I have a lot of trades in TNA, um, and then SPXL. I have a lot of trades in SPXL, and I've recently started using Fang. I call it Fangu. You notice I've been watching this all year. I have not traded it, and people are like, "Well, you should have bought it when it was low." Well, whatever. Like, I don't trade something until I feel confident in it, and I just started trading this. Um, actually within the last couple weeks. So but you can see I've been trading this theory in other broad markets that are associated much longer. And the basic theory is that you buy on red days and you sell on green days. That's the basis. And that you buy on a red day towards the close of the day. Or if there's high volatility, you can buy intraday, and then you get then that's the volatility. You have to have VIX in there too. If it's a high volatility news day like here, you can see right here. I bought it. This was intraday, and pulled back probably another about 2 or 3% there. Again here, bought it intraday, and then I bought it close to the close, simply because it was a high volatility day. These trades here weren't really vetted yet. I mean, I just started working on this not too long ago, so I mean, had I been trading this earlier, I would have had some trades in here just because of the volatility of the market at the time. So, the idea being that you buy at the end of the day. Usually, when I say end of the day, I mean somewhere around 2 o'clock. You have to look at charts, intraday charts, 1 minute, 5 minutes, okay. And you want to buy when you feel that the selling pressure has ebbed. And sometimes you're going to get screwed, like where you just buy and then the selling pressure comes on at the end of the day, and you're whatever, you know. And I do trade this. If you look at greens are buys, reds are sells, and my reds are 50% of position. So that's half my position. That was these buys right here, and then that's the other half. I buy in, half goes out here. There's the other half. I buy, and this is still when I'm still working on this theory. Like, these buys are not good. I mean, they were good because they were profitable, but still, they could have been better. So I buy, and then buy, and then there's my 50% sell. There's my other 50% sell, and I bought a little more in between. So you have to get a good feel for the over market, attitude. We came out of a huge push up through 2017. I mean, you got this massive move through 20. You got a massive pullback, and it's like the ocean. If you're a surfer, you know how it works. You watch the ocean for a little bit, you get these huge waves that come in, huge waves, and they pull out, and then another one comes in, another one comes in, another one, and if you understand Elliott wave theory, the market is kind of like a pebble in a pond where the ripples start out big and they slowly decrease in size. So a move up slowly decreases in size, and a move down slowly decreases in size, which is part of this concept. And so, like, let's say you have, okay, in my case, I have $20,000 in capital per position, and I base my entries. I either determine if it's a high volatility situation. I do quarters, so like 1/4. So I'll do 5,000s. but my initial positions are always much smaller than the last one. Like that one was double the size of those two positions. Um, these are tiny little positions. Those two positions are the same as that, and this position is the same as all three of those together. Right? Most recently, I just added a little bit here because it was a little bit pullback. But the general theory is if you look at this chart and just take a look at the chart and say, okay, I bought at the end of the day here, bought at the end of the day here, bought at the end of the day here, I bought at the end of the day here, I bought at the end of the day here, and it pulled back. I bought a little bit there, I bought some more there, I bought some more there, I bought some more there. Had you bought at the end of every red day and sold on the next move, which made all your buys positive. So like these are all that move would have made all those buys positive. Had you sold there, you would have made 4 trades 100%. Right? On this move down here, that was a little lackluster on the trade there. And I usually don't buy on the first red day back. I did here just because I felt like it. And this was a red day and I felt like it. But I felt the market was fairly consolidating over this resistance point we're here, which it was. Or support at the point. Well, it was resistance and it became support. And that's why I added a little bit to it. I should have added more here. But this theory does not base on buying on green days. So it's not 100% perfect. But the theory is that if you look at a chart and you buy on red days towards the end of the day, because there's limited wicking, there's limited return on price movement towards the end of the day in the broad market, you'll be profitable. I mean, look at this buy here. That was like at 2 o'clock. I'm not gonna bust this out to 5 minutes or 1 minute and go back to that day, but that move back I'm pretty sure happened within the last 2 hours of trading, and that was a 2 o'clock trade. Somewhere a 2 o'clock trade, whatever. It was a high pressure day, and it just, I mean, that's a high pressure day because the market was moving down for like several days in a row. And then that high pressure sell. I mean, you got over average selling, or you have over average volume that was red. But and then you have a day like this. You have way over average red day. That's probably a 2 o'clock trade, and that's probably an end of day trade. And the key is breaking your position. Say, okay, I have $5,000 or I have $10,000 or whatever, and then realizing that a negative move generally takes, it's like steering a large ship in the ocean. A negative move does not happen for only one day, except for when you get into a situation like this where this is actually entering like a consolidation period where your intraday moves. I mean, you're not hitting 5% on a day. You're hitting like 2%. It's waffling. It's just tight. You know what I mean? The market doesn't know which way to go. On days like on this move there, like, there's a lot of money to be made because the market is just like, yeah, sell it all. Well, if you're gonna sell it all, I ain't buying during the day. I'm gonna wait till the end because the sell it all mentality is not gonna end in one day. The sell it all is gonna go for multiple days. And in this case, when it pulls back, you just let it go. You could have bought here, and it would have taken you 3 weeks to get back to even. But the next day, had you bought at the end of the day, if this was double your position, it literally would have only taken you like a week to get back to positive. That's a pretty heavy move down. So that's not a really good example. But the key is, the moves shorten as time goes on in a bull market. So you have a big pullback. You buy on the red days towards the end of the day. I'm talking like, I mean, if you look at this day, it didn't pull back till the last 10 minutes of trading. So If the market's red, you're looking to buy, and you're only looking to buy towards the end of the day, or if there's a huge pullback and then the market can't pull back any further. For instance, the market was a fairly large pullback day after a moderate volume. I mean, that was a heavy selling day in that time frame, that 2 week time frame, and the market couldn't hold the sell off. So that was a buy signal, and I won't break it down to the intraday charts, but overall, buying red days, usually not the first red day back. Like for instance here, like you wouldn't be like, oh, it's a red day, I'm buying heavy there. Well, you would have made some money on the next day, but that the market was going to keep pulling back, and you had all these buyers coming in intraday, but the market was still pulling back. So that's when you buy, and if I was a really wanted to hit it hard, I would have bought more there. But as you can see, looking at the chart, buy red days at the end of the day, or when there's a strong volatility day and the market can't pull back any further, that's when you enter some positions. And break your position, say, into 4th or 6th, and then you will... I mean, this trade is... I have a 100% win ratio on this. Every trade is positive. And that's in SPXL. We can switch over to TNA. I mean, that was a dumb buy right there. See, you can tell I'm still figuring this stuff out. But you have good buy, okay buy. But that first position is half of every one of these other positions. And that was a mediocre buy because I thought the market was going to rip. Still pulled back for another day, and then it ripped. And that's a considerable move. I mean, that's an 8% move right there over the week. I probably should have sold at the open here because I had 3 positions in. Average was 5% up, 4.5% up, and I should have done it. But I'm okay with that. So your initial positions are whenever the stock market pulls back on these broad markets, and then I'm only using this trade in these 3 ETFs. Whenever the stock market pulls back, the first couple red days, you got to be like, the move is not going to finish within a couple days, especially when there's high volatility. You have a green day here, which I sold on. The next day it was red. I could have bought back in right there, but chances are it's not over. It's not over within 1 day. There's 2 days, 3 days, 4 days, 5 days. It's a week before it moves back up. But had you bought red at every one of those end days, and because of my sizing, I can't buy like every day because I'll burn through the total position within a couple days. So, you can say, well, I'm going to buy in 8ths or I'm going to buy in 6th. Well, then you can buy at the end of a red day. But to me, I usually buy in 4ths, and so I want a heavy sell day. You know what I mean? Buy a little on the first red day back, but it's not going to be the first red day back is not the last usually. Just look at the chart. I mean, you don't need. I mean, the first red day back is not the last. The first red day back is not the last. The first red day back is not the last. First red day back is not the last. I mean, that's what you have to know. The first red day back is not the last. Here, same deal. It's not that hard in my opinion here. This is extremely easy to see. And I'm talking, this is 7 months. You know what I mean? It's not like, well, this worked last week, it's great. Buy red days End of the day, buy red days. If the high volatility in the stock market can't pull back any further than it is, probably around 1 o'clock, 2 o'clock, um, and then realize that you're going to be in a negative position for multiple days in a row, but you're playing this on a 2 week or 3 week or 1 month time frame, and you have X amount of position, and you're breaking it into fourths. And my opinion is, even if you quote unquote break it into fourths, your opening positions on red days. Let's see what an example here. Oh man, that was a terrible buy. But like here, so like we had 1, 2, 3. We had a couple, like it was like topping out. I mean, the trend line was showing that it was going to top out here. I just bought a little bit. That's double the position. That's double. That's this position together. This is all those positions together. So when I move back up here, I'm positive. I think this is probably one of the only cases where you say like I had a losing trade, because like these two positions I sold right here, but that's only because or no, whoops. Yeah, that's not a really good trade example there. I sold something. This is a long time ago. I can't remember what it was. I think I sold off these first two positions just so that I had a heavier weight at the bottom. So that actually, I may have, a 95% win rate with this one. But that's when I first started trading it. So knowing now what I know now, I would have left those on. And that was a pretty heavy drawback too. So you'd have left those on, you'd have been positive in 4 months on those trades. But in general, buying towards the end of the day on red days, slowly pyramiding in your position, it's a very good strategy. And at least through these ETFs, SPXL, and, TNA, and I'm starting to work it in FANGU, whatever. But it's been pretty good for me. It's been my number one trade. I've been trading for about 3 years, 2.5. And this is a strategy I've worked on, looked at for a long time, and just started implementing this year, and it seems to be working pretty well. So, again, I'm not a professional. I really don't know a whole lot about the markets, but hopefully it works for you guys. And enjoy. Good luck.